Obviously, the markets have made a lot of investors pretty nervous. It seems at least the pace of which the sell-off has accelerated, at least jarring some nerves. But I understand you're looking at history. You're trying to calm us down. What do we know about the beginning of presidential terms and how markets behave?
Yeah, good morning, Courtney, and thanks for having me back. So, this year, I know the headlines are scary and the volatility. We just had one of the quickest 10% corrections we've ever seen. But at the same time, what do we know coming into this year? The first quarter of a post-election year is usually one of the worst quarters out of an entire four-year presidential cycle. Early, after a 20% gain, you tend to be choppy. The last 20 years, ready for this one? The first quarter is pretty weak, but the last 20 years, the S&P's bottomed on March 12th on average. We just bottomed on March 13th. No, you never blindly invest in just seasonality, but it made sense to us that we're probably going to have some choppiness. So just one thing I was working on before I even sent you the notes yesterday, the last 2 days, more than 90% of all the stocks in the S&P 500 were higher. That is extremely rare. And that's usually not a sign that, listen, usually a sign the sellers exhausted themselves. Everyone got all bared up. And then the bulls take over. Just one more context on this. 11 times, I got data back to 72 on this. 11 times this has happened, okay? Back-to-back 90% days. 6 months later, higher every single time, up well over double digits. A year later, once again, higher every time. So it is what it is. What we've just seen the last 2 days very well could be saying we're trying to make a pretty significant low, and we might rally. I know it sounds contrary to what we're hearing, but it could be happening.
That's really interesting. Your data specifically, I was very interested in that March 12th bottom when I was looking at that chart.
Yeah.
I mean, when we're looking back at even just the last several Marches, I mean, think about what happened in 2023 and in 2020. So does that also sort of set us up for sort of these, I don't know, bottoming out comparison levels that should make us a little bit more comfortable about where we're sitting now and how that looks going forward?
It really does. And obviously this time, 4 or 5 market days ago, it wasn't very comfortable, right? Market in a correction, everyone worried, but you look at things like put to call ratios. We saw a huge spike in put to call ratios last Thursday. We know investor sentiment polls. We've got over 55% bears 3 weeks in a row in that AAII poll. I know lots of guests have mentioned it. Yes, there's some flaws in this, small sample size. They're probably too leveraged in the Mag 7. Still, you're talking March 2009, the last time we saw something like that. So when you kind of stack all this together, expectations are very low. Markets can take good news. Markets can even take bad news. They don't like uncertainty, and that's clearly been the word of the day, of the year. If we get any decent news at all, and maybe it's on the inflation front, maybe it's going to be from the Fed, tomorrow. But again, we're pretty optimistic. We're trying to make a pretty good low. One final comment on this. When the U.S. had its 10% correction last week, Germany's hitting all-time highs, like you mentioned right before it came on. China's hitting multi-year highs. Europe's up double digits. I mean, it's hard to think there's a global big bear market coming when everybody else is going up. I think that baton's just being passed around. We do think the U.S. is going to start to do much better here, but that's not bearish. The U.S. taking a break in the first quarter. I think it made sense after the rally we've had for 2 years.
And if you look at the chart that we're showing right now, month to date for the S&P, you can sort of see this downward trend, but then just most recently, you see that sort of upward tick again, to your point about sort of this mid-March area of bottoming. Even though we know that history doesn't always exactly repeat itself, we also know that it can, and there is some seasonality. But obviously, this could be an opportunity if you've got the stomach for it. I know in one of your charts, you sort of say, look, volatility is the toll that we pay to invest. So can you give us some actionable advice here as we wrap up the segment?
No, that's right. It is March Madness. I got my Xavier pin on. I'm a Xavier guy, so welcome to March Madness.
Hey, I'm an Ohio girl,
There we go. Yeah, that's right. So I'm in Cincinnati right now. So anyway, there we go. What'd you ask me? Volatility. It's early. Volatility is the toll we pay to invest. That's what we say around the Carson team. On average, once a year sees a 10% correction. Okay, you're going to see 3 to 4, 5% mild pullbacks every year. This year, yes, this is one of the quickest ever. When I look back at quick 10% corrections like we just saw, only 6 of them. Okay, within, like we just saw, this quick. Once again, 6 months later, S&P's higher every single time. So what we've just seen was very uncomfortable. It's worried a lot of people. There's a growth scare, stagflation. It's a growth scare, but we don't think we're going into a recession. Look at stagflation. You've got wages going lower. You've got oil the lowest it's been in a while. We're not worried about stagflation. So overall, we think, hey, there's an opportunity here for the rest of this year. We still like the United States. We think financials, industrial still look pretty good, but diversify. For the first time in a while, bonds are doing well. Gold, like you said, is hitting all-time highs. We've got a little bit of exposure in the models we run for our Carson partners, owning some of those things to be more diversified versus last year when we had a lot of bulls or a lot of U.S. stocks.
Very interesting. So you could make some money in gold, perhaps, if we're believing sort of your thesis. Fixed income, maybe not so bad if rates stay where they are, and some exposure maybe in financials, too.